In this example problem, we're going to be doing some accounting for construction in progress. And construction in progress is a lot like work in process. It's us constructing some kind of asset that's going to be sent to somebody else. The difference being is WIP, work in process, gets used for short-term assets, for current assets, inventory that you produce. While construction in progress typically gets used for some very large asset that's going to take you multiple periods, accounting periods, to produce. And in our case, let's pretend that it's a building. So we're going to be company A constructing a building for B company. B company has agreed to pay us $1,590,000 for this building. They're not paying it in one lump sum. I'm going to imagine by the way these numbers are working, that we have some kind of contract where they pay us a certain portion of that amount when we meet certain milestones in construction. So when we get the foundation in, we get a certain amount of money. When we get the framing done, we get a certain amount of money. When the exterior is put on, we get a certain amount of money, etc. But we have a bunch of information to work with down here. And for this project, which started in 2025, that we're going to complete in 2026, our actual construction costs incurred during the first year of 2025 were $191,550. That was the first year, so there would be zero construction costs incurred during the prior year, meaning that at the end of 2025, the total amount that we had incurred to that point in time was just 2025's costs of $191,550. We are estimating at the end of 2025 that it would cost us $446,950 to complete this task. And our estimated total cost, therefore, would be what we already put in, the 191,550 plus the 446,000, giving us 638,500. We have billed Company A has billed B Company $980,000 during 2025. And of that 980,000 that we billed them, they have paid us for 795,000 of it when 2025 ended, which brings us to the second year of this very long time that's going to take us to construct this building. Our actual construction costs during 2025 were 865,000. If we add that to what happened in the prior year, that 191,550 from 2025, we come up with our total cost to incur, $1,056,550. So we spent $1,056,550 to construct this building, which we're selling to B Company for $1,590,000 when it's done. And it is done because our estimated cost to complete are zero, making our total estimated cost equal to what they actually were at the end of 2026, because we know we finished the job. We billed them for another 610,000 during 2026, bringing that total up to 1,590,000 that we billed them, and they paid us another 795 grand, making our total cash collections 1,590,000. So while you would do this in practice piece by piece by piece, as you're going through the way that your homework assignment is set up, it has you accounting for the entire life cycle of the construction and progress at one point in time. And we're going to do so using the percent of completion method. And we'll get there when we start recording the gross profit entries for this transaction. But let's start with entry one. We need to record the actual construction costs that were incurred during 2025. Well, we'll say that this is being recorded for the lack of a better date on New Year's Eve 2025. Let me blow that up to make it a little bigger for everybody to read. There we go. And we need to put those costs onto our books. Well, why are we incurring those costs? Because we're constructing something we're going to sell later, which makes it by definition an asset. It's something that we're going to use to generate revenues in the future. And that asset is going to be called construction in progress, or CIP if you want to feel fancy. And this is an asset account going up, so we need to debit it because asset accounts always go up on the debit side. And it is going to be for the cost that we incurred during the first year, during 2025, which our information tells us is 191,550. For the credits for this, typically it would be all of the stuff that went into it. So any cash you paid for expenses, the raw materials you used in production, anything being allocated out of your overhead pool, etc. This entry would typically have a very long list of credits for all of the components that went into that construction in progress. The question that I have given you for your homework is just telling you to bill everything to cash. So let's do the same thing here. Also for 191,550. And here we recorded the actual 2025 costs for the B company job. Moving down to entry number two, we need to record the progress billings to B company in 2025, how much we actually billed them for during period. So I'll make this entry at the end of 2025 as well. If you're billing your customer, billing B company, and they now formally owe you money that you're going to collect cash for at some point in the future, that you're going to receive money for at some point in the future, that is an accounts receivable. And I feel like using a subsidiary account here to know that it's from B company, so I'm going to call it AR-B. Sounds weird, accounts receivable-B. And then that's going to be for how much we actually billed them during the 2025 year, which our information tells us that our progress billings made during 2025 was 980,000. The account that I'm going to credit right here is billings on CIP, or construction in progress. This is a contra asset account. And this account right here basically reduces the value of your asset. Why? Because assets should be valued at what reasonable amount of cash you expect to convert them for later. We can't convert the building and this accounts receivable into the same 980,000. So we'd have to subtract it from the value of one of the assets. And we're going to use this contra asset account to reduce the balance of our construction in progress. And yes, it looks negative right now, but it won't be for very long here. So for this entry, we recorded 2025 billings to B company. The next entry is asking us to record cash collections from B company in 2025. So on 12/31/2025, we are going to record the collection of cash from B company, and our information, well, that's a plus, not a minus, apologies, a plus. And our information tells us that we collected $795,000 from them during 2025. So I'm going to debit cash for 795 grand. Since they paid us that much, they don't owe us the full 980,000 anymore. I need to reduce accounts receivable dash B by that amount to adjust the value of the receivable to what they still actually owe us. And here we recorded 2025 collections from B company. And now we need to record the profitability that we had during the period onto our books. We haven't recorded any revenue in those first three entries. And the rules of the GAAP revenue recognition principle say that you need to put revenue on the books in the period that you've earned it. And we've earned some of this in 2025. We've been working on this building that we're going to sell to B company, so we deserve to be able to put some revenue on the books. But the way that you value how much of it you've actually earned isn't quite so easy. And what we're going to use here is the gross profit method to calculate what our actual amount of revenues recorded should be. So let's start with the year. We're doing this for 2025. Our cumulative construction costs, all construction costs incurred to date, up in our table, tells us that at this point in time when we're recording for 2025, it was $191,550. Our estimated total job cost, what we were estimating at the end of 2025, was $638,500. And if I go and I take my cumulative costs incurred to this point in time of 191,550, and I divide them by the estimated total cost of 638,500, I come up with 30%. Based upon our estimate of total cost and how much we had tracked at this point that we had actually put into the construction of this, we've incurred 30% of the costs that we are going to incur in total on this job. And if that's the case, why don't we record revenues equal to 30% of the contract price? So the contract price up on the top is 1,590,000. Let's bring this down into our calculations. We just determined that based upon our estimates of costs, we're 30% of the way done with this job already. And if I multiply the contract price times our percentage of completion, I come up with $477,000 worth of revenue that we should be recording at this point in time. Have we recognized any revenues in prior years? Absolutely not. This is our first year of construction. So I'm going to throw a zero in there, which means we need to recognize all of that revenue, that 477,000 during the current year. What would our profit margin be on this? What we're saying right now is we've earned $477,000 worth of revenue, but to do so, we incurred $191,550 worth of costs. And if this was just the end of the line, if we were in fact selling them a building for $477,000, that we incurred $191,550 worth of costs to make, well, then our gross profit recognized would be 285,450. Or if you want to look at it another way, when this job gets done and we record our actual full job gross profit, 285,450 of it would have come from the work that we put in 2025. Well, now we got a journal entry to record over here. And the first thing that I'm going to do is I am going to debit construction in progress for the amount of presumed gross profit that we made off of this job during the current year that I'm recording a journal entry for, which is 285,450 bucks. And that is putting the value into the asset of what we've already earned. We haven't actually sold this to them yet, so we haven't turned it all into revenue right now, but that portion of profitability should go into our assets. We've already, set it up to be so at a later date. For our debit over here, you could record the expense and you can name this thing a bunch of different stuff. I'm just going to call it construction costs. If you wanted to be really fancy, you could have like 5 million debits right there for all of the particular costs that went in, but we'll just call it construction costs. And that's equal to your costs that were incurred during the year of 191,550. And then on the credit side, I get to finally record my revenues. I'm going to call it revenue on long-term contracts. And here, this is just going to be equal to the sum of our two debits to make our debits equal our credits in the journal entry. And you'll see it's the $477,000 worth of revenue that we should have recognized for the current year on the estimate that the job is 30% done. And here we recorded 2025 revenues on the B company contract. And that is how that procedure is going to continue to work. We are going to continue, in this case, to value our construction in progress at what we've put into it, in addition to the gross profit that we've expected to have already earned off of the job. And we'll recognize revenues on long-term contracts equal to the prorated amount of the contract price based upon, how much of it we have finished. So in entry number 5, we're just going to start repeating this whole process again for the second year of this. So on 12/31, this time 2026, we're going to record the same entry that we did up in entry 1. We are going to put the costs actually incurred during 2026 on the books with a debit to construction in progress, increasing that asset. And we'll once again, instead of having a million credits here, just assume that it all came out of cash. And what was the actual construction costs that were incurred during the second year, during 2026? Well, our actual construction costs incurred, according to our information, were $865,000. And let's make that our credit to cash as well, assuming it all came out of stuff that was paid for in cash. We recorded the 2026 actual costs on the B company contract. Let's get that receivable on the books for how much we billed B company during 2026. And that entry will be the same as up above. Debit to accounts receivable dash B, asset account going up. And we are going to credit billings on construction and progress, which will reduce down to CIP. Contra asset accounts going up. And the amount of billings that we had on this during 2026 were $610,000. So let's debit our receivable for the amount that we billed them and create a contra asset account for 610,000 as well. And here we recorded 2026 billings to B company. In entry number 7, we are going to record cash collections, and it's going to look just like it did up above. When we had that in 2025, we had a debit to cash and a credit to accounts receivable B. I'm going to be lazy and copy and paste. There we go. And it's for the amount that we had collected in cash from B company in 2026. So I can go up here. And in 2026, we collected from them another $795,000. So here we recorded 2026 collections from B company. Then we have to do that gross profit entry again to put the revenues on the books that we are assuming that we earned by using the percent of completion method during 2026. So the year would be 2026. Our cumulative construction costs incurred to date in 2026 would be $1,056,550, which, by the way, our estimate for how much it was going to cost us to complete at the end of 2025 was terrible. We said it was going to cost us $638,500 to finish. We ended up having to spend $865,000 to finish. That's a reason to complain at whoever came up with that estimate. But for now, we're just going to put the $1,056,550 in total of construction costs that we've incurred to date on the books. What is our estimated total cost? Well, this job's done. So our estimated total cost should be the same as our cumulative costs that were incurred. And I think you know where the percent complete is coming from for this. We're just going to divide our costs incurred to date by our estimated total cost. We're 100% done with the job. Well, the contract price, just as we had in the last graph, I'll steal it from here right now, is still 1,590,000. It's now 100% done. So our cumulative revenues that we should be recognizing is the full contract price of 1,590,000. Well, how much revenue have we already recognized on this contract? Well, going up here, we've already recognized $477,000 worth of revenue. So what is left to recognize? Well, if we're selling this thing for 1,590,000, we have to recognize $1,590,000 of total revenues. But we've already recognized 477,000 of that. So we have to put the remaining $1,113,000 worth of revenue on the books. What is the actual amount of costs that we incurred to make this building? In total, this building right here caused us to incur actual costs of $865,000. I'm not putting the whole amount of total cost on there because this portion would already be on the books. So I'm bringing 865 grand down here. So what we're saying here is just isolating out what happened in 2026. We earned $1,113,000 worth of revenue. We paid $865,000 worth of construction costs, if you will, to do so, which means the amount of profit that our operations during 2024 contributed to this job is $248,000. So in our journal entry on New Year's Eve of 2026, we're going to record the same exact entry that we did up here, a singular debit to construction in progress, a debit to construction costs, and a credit to revenue on long-term contracts. But we're just going to do it for the 2026 numbers. So what was our construction in progress? That is equal to our gross profit. Our construction cost just for 2026 were $865,000. That was our actual cost for the period. And the amount of revenue that we're going to recognize on this contract is $1,113,000. And then we need to record the entry to complete the contract, and you would have some kind of thing in here to actually collect the remainder of the cash. Well, we have that, right? We've collected $795,000 twice. So the cash that we have on the books between these 2 years is equal to the total price. We would need to have their receivable be equal to zero. Well, if you go through and look at all of the transactions right here, you will see that you're going to zero out their AR account from all those collections, so you're good there. The thing that we have on the books right now, and we even have all of the costs on the books recorded as expenses, the thing that we have on the books right now that's got to go is we're done. We finished the building that was a piece of construction in progress, and that has to come off the books. And so does our billings on construction in progress. Those accounts are no longer needed because the job is done. Well, billings on CIP is a contra asset account. If we want to take it off the books, like all contra asset accounts, we have to debit it. So we're going to debit billings on CIP. And construction in progress, this whole entire time, we've been increasing with an asset as with a debit. Well, let's credit that to take that off the books. So we got our construction in progress, reducing that asset account. And this should hopefully be for the full contract amount. Well, let's double check our work. I have a couple of T's down here for the two accounts that we just used. We've got construction in progress. We've got billings on construction in progress. What is the balance of these T accounts right now after we've gone through and done all of these journal entries? So I'm going to go up and find my construction in progress. And my construction in progress got debited on this first entry for 191,550. Let's bring that down to our T account. My construction in progress account got debited in this fourth entry for 285,450. My construction in progress account got debited again for 865,000 in journal entry number 5. And construction in progress got debited one last time right here in journal entry number 8 when we use the gross profit method to put revenue on the books that year. And what is the balance of this account? Well, it would have a debit balance now equal to the sum of those four numbers, which is, ta-da, 1,590,000. And if I credit this for that same 1,590,000, well then, what happens when I subtract out that credit to my T account? It's gonna zero out. So I know I need that credit right there for 1,590 grand. So let's throw that $1,590,000 credit into our journal entry. And I know that debits have to equal credits, so this is also going to be 1,590,000, but let's be thorough. What amount of billings on construction in progress did we put on the books? We put on the books a debit the first time to billings on construction in progress of right there, 980,000 during 2025. And during 2026, we billed them for 610 grand. So all in all, this is going to be equal to the sum of those two numbers would be the balance of the account, which is 1,590,000. And as you can see where I'm going here, this debit right here will reduce this down, once I get the formula corrected, down to zero. And now both of our accounts are zeroed out and we don't need them anymore because we're no longer working on this building. It is no longer construction in progress. So right here, I forgot to put the description in this entry. That would be recorded 2026 revenues on the B company contract. And then for the last entry, we are going to say that we completed the B company job. And that is how construction in progress accounting works if you're using the percent of completion method. And for some reason, if we were building an asset that was going to take us 9 years to complete, we would just keep doing this over and over again every single period to get things done.